Today, cats out of bags. The DFA Daily to the 17th of August 2021. Hello again, it's Martin North from Digital Finance Analytics, where I notice posts covering finance and problem news with a distinctively Australian flavour. Just before we start, a quick reminder that at 8 p.m. Senior tonight, I'll be running my weekly live show. And today I'll have the lawyer Amanda Farmer on to talk about strata and strata law. This will be an interesting and important discussion, bearing in mind so many of us now live in high-rise as well as low-rise, and so strata is an important part of life. And there are many questions that we'll be exploring, so make a note and join us at 8 p.m. Sydney tonight. Now, in today's show, we look at the RBA's thinking on migration and wages growth, why lenders praise rising home prices, the downward revisions of economic performance thanks to the extended lockdowns, risks and guarantor obligations, some crypto news, and New Zealand rate rises. But firstly, recently RBA Governor Philip Lowe claimed, in fact in July, that high immigration levels were in part to blame for years of low wages growth. But now documents obtained under the Freedom of Information laws shows that the RBA's Economics Research Department has been doing research on those issues before Lowe's speech. And they found that people on student and holiday visas, in particular, had contributed to low wages growth prior to the pandemic, as had the partners of people brought into Australia on skilled visas. Now, here are some of the main points buried in an FOI, which, by the way, contains many blank sections. The estimates that they started with was that there had been persistent spare capacity in the labour market for at least the last decade. That coincided with declining wages growth across all sectors of the economy. The medium and long-term structural factors most likely contributing to persistent spare capacity and therefore low wages growth at present are changes in Australian immigration policies and the composition of the immigrant pool. Over the past 2 decades, they said, Australian immigration policy has supported high levels of migration of both skilled and unskilled working-age persons. This has expanded the labour supply. The impact on spare capacity and wages is different for skilled and unskilled workers. The largest growth in migration by far has been for unskilled migrants, primarily students, working holidaymakers and family visa holders. These migrants have partial or full work rights and tend to work in the lowest paid jobs, for which domestic labour is relatively easily substitutable. Skilled migration has become increasingly targeted to filling jobs for which there is not an immediate available domestic substitute. Occupations open to skilled immigration have wages significantly above the national median. Immigration of the primary skilled visa holder is likely to lessen wage growth pressures in those occupations, which have a marginal impact on spare capacity. In particular, it might marginally increase spare capacity by reducing incentives for employers to invest in available but poorly matched domestic labour supply. And it went on to say a significant part of the permanent migration stream is comprised of the partners of skilled migrants, for which there is no skilled requirements but full work rights. This increases spare capacity, as these secondary migrants do tend to participate in the labour market and have characteristics similar to incumbent workers. So you can see there that the significant pressures around wages is significantly linked to migration, particularly if you allow in lots of low-paid workers. Now, that's something that we need to think about quite hard, because I fear the government may well wish to open the migration taps as soon as they can, another form of QE. Elsewhere, Bendigo and Adelaide Bank's net profit for 2021 rose 172% to $524 million, with its cash earnings rising 51% to $452.2 million. Deposit growth increased by 14.2%, whereas applications for loans surged by 36.2%. Most of this was volume-driven, with margins compressed, even if supported by the Term Funding Facility, plus the release of earlier provisions. But I got more concerned by comments from MD Marley Baker, who said that rapid price growth in houses is, quote, fantastic, and claimed that macroprudential regulation is not needed as activity is being driven by owner-occupiers rather than investors. She said, rapid house price growth over the past year has been fantastic for the economy. We'd start to have some concerns when it gets too heady for investors, but we haven't seen that today. When we see people buying homes and living in them, this is terrific for the economy. I'll leave it up to the regulators as to what decisions they make, but if we look at the market at the moment, it's predominantly driven by owner-occupied lending, and I think that's a great position to be in when we talk about how we move forward with the economic recovery in this country. Now, it's worth underscoring, of course, that the growth in higher loan-to-income, higher loan-to-value and debt-to-income ratio lending has increased, and the risks are increasing, so I'm afraid she's talking her book. Of course, banks make most profits from mortgage lending, and the more they can lend, the more profitable they become, especially when supported by cheap money from the central bank. Elsewhere, Commonwealth Bank says that data for July 21 has shown the impact of lockdowns across Australia, with declines in spending intentions across most categories, including home buying, retail, travel, entertainment, education and motor vehicles compared to July 2020. They said this is the first time that year-on-year spending intentions has fallen across most categories since the start of the COVID-19 pandemic. The only exception is health and fitness spending, which remains higher over this period due to elevated spending on doctors, hospitals, medical labs, nursing and personal care, orthopaedic, osteopaths and podiatrists. While spending intentions for home buying, retail, health and fitness and entertainment remain higher than July 2019, considered the last normal year, spending intentions for travel, education and motor vehicles are for the first time down in comparison to the same period. CBA Chief Economist Stephen Hulrock said rolling lockdowns in many states and the extended lockdown in Greater Sydney had impacted most areas of spending. Australia's economic recovery from last year's COVID restrictions was impressive, as reflected by the sectors of the economy covered by their analysis. However, this changed in July, and unfortunately the spread of the Delta variant of the COVID-19 virus has seen a combination of rolling lockdowns used across much of Australia, including an extended lockdown in Greater Sydney. More recent CBA credit and debit card spending data shows the ongoing impact of lockdowns, with national spending to the 13th of August flat relative to 2020 and up just 4% against the same week in 2019. This supports our view that the Australian economy will contract by 2.7% over the quarter in quarter 3 21, and a revision of their GDP growth forecast to 3.6% from 5% earlier on. And CBA's series offers a forward-looking view on Australia's economy by analysing actual customer behaviour from CBA transaction data, along with household spending search activity from Google Trends. That combination provides, they say, a unique insight on prospective household spending trends in the Australian economy. And meanwhile, Westpac says the situation in New South Wales has deteriorated rapidly, and they have extended the forecast lockdown in New South Wales from the end of September to the end of October. Well, that's pretty optimistic, I would say. It's probably going to be later than that. While there have been some positive developments around restrictions on construction sites, generally guidelines have tightened, and we now expect, they say, only 50% capacity to hold until the end of October. They also recognise, they say, that unlike in the July 29 forecast, the entire state of New South Wales will remain locked down from mid-August until the end of October, while restrictions in New South Wales have been tightened to 5-kilometre restriction on travel, 12 locked down to LG8, up from 8, and potentially other restrictions. Their forecasting timing of the easing of lockdown in New South Wales is not based on an estimate of the timing of achieving sustained zero cases. Rather, they're basing their forecast on the likely achievement of 80% full vaccinations of 16 years and older in New South Wales. Sidebar there, of course, even at 80%, we won't have herd immunity, as I discussed yesterday. Our current estimates of that timing uses a linear forecast out to the end of September, assuming the same pace of vaccination that we've had recently, to be followed by a lift in the pace in October as the supply of Pfizer increases at the pace which has been outlined in government documents. Their estimate for New South Wales put full vaccinations with 2 jabs at 80% of 16 years and over by mid-October, and they allowed 2 more weeks for a period of easing in restrictions through to the end of the month. And they have also increased the extent of the lockdown in Victoria in their modelling from 3 to 6 weeks, total of 4 weeks for the current lockdown. The timing of the easing of the Victorian lockdown is based on the expected achievement of sustained zero cases. Under those new assumptions, they forecast that the New South Wales economy will contract by 8.3% in the September quarter, but expand by 4.3% in the December quarter of 2021. That's compared with 7.8% and 5.8% in the earlier estimates they published. For Victoria, they forecast a growth rate of down 1% in the September quarter, including a strong bounce back in the month of September, when the lockdown is forecast to end and 2.6% higher in the December quarter. That compares with down 0.1% and 2% in the earlier estimates. One key to these estimates, they say, is the pace of recovery in New South Wales once the lockdown ends. They're estimating a lift in hours worked in the month of November of 4.5% and then an increase of 3.6% in December. While that recovery appears to be quite sharp, it is in line with the bounce back that we saw, they say, in Victoria following extended lockdown last year, when hours worked lifted by 5.2% in October and 6.1% in November, following an 8% contraction in August and September. As before, they say, we're assuming ongoing growth in the remaining states through to the end of 2021. And nationally, the profile for output over the second half of 2021 is a sharp contraction of 2.6% in the September quarter, downgraded from 2.2% in our July update, followed by a 2.6% rebound in the December quarter, downgraded from a 3% upgrade previously. Under those estimates, the Australian economy grows by 2.4% in 2021, down from 3.2% in the earlier forecast. However, they retain a view that the combination of globally high vaccination rates, pent-up demand, rising housing markets, strengthened household and business balance sheets, and expansionary fiscal policy in election year will support a very strong recovery in 2022. And they expect the post-lockdown bounce back to extend into 2022, with the March quarter registering 2.4% growth and 5% growth over the full year in 2022, and that's up from 1.8% and 4.2% respectively in their earlier profile. But I think the thing they're missing is, one, the very significant impact on small businesses around the place. In our surveys, many small businesses are close to the edge, if not failing now, and many households are finding their finances are under pressure, and of course the level of government support is much lower this time. I think unemployment is going to be a lot higher than people think, so I think those forecasts are way too optimistic. A watchdog has highlighted serious concerns after reviewing the bank's compliance with guarantor obligations. The Banking Code Compliance Committee, the BCCC, which monitors banks' adherence with the Banking Code of Practice, just released a report summarising its inquiry into guarantee obligations. The review was prompted by unexplained inconsistencies in banks' breach data over a number of years, as well as concerns around evidence given in the Royal Commission. More than $500 billion of both consumer and small business credit was supported by guarantees in 2018, but after completing performance audits of 13 banks, the BCCC has found non-compliance with a number of the industry code's provisions, including pre-guarantee disclosure requirements. The committee has raised concerns about failures to consistently provide full disclosure of key information to guarantors, an issue linked to poor record keeping practices, and challenges associated with systems, business units and subsidiary brands. And the audit also found multiple instances where banks could not demonstrate their compliance. While the banks were ticked off for having adequate policies and processes, they were also said to lack effective record management practices. They had examples, including not being able to show key information that was given to a prospective guarantor before accepting the guarantee, or not being able to show the guarantee was executed in the absence of the borrower. Further, community legal centres cited instances where they had requested guaranteeing documents on behalf of clients and key documents had either not been retained or had been lost, and conduct inadequate or ineffective monitoring of compliance controls. All of the audited banks found control gaps in their guarantee processes not previously detected by routine monitoring activities, and they relied too heavily on legal advice when considering the enforceability of a guarantee. Banks were also found to consider what actions to take on a case-by-case basis when they became aware that they had not complied with the code. And while this is appropriate to obtain legal advice, the BCCC said it was also important for the banks to avoid an overly legalistic approach, referring to a code obligation to engage with guarantors in a fair, reasonable, ethical manner. The banks also did not provide details about when or how they communicated non-compliance to affected customers and guarantors, and they lacked the capacity to collect guarantee-related data. The banks confirmed that they had difficulty providing requested data about guarantees, and information was stored in a variety of ways, including as paper files in branches or storage facilities in individual customer files with different systems for subsidiary brands and businesses. Collecting data was also largely a manual process, according to the report. Some of the banks also could not distinguish between consumer and small business loan guarantees, and the majority of banks do not have readily available data about guarantee outcomes, such as the number of guarantees enforced for any given period. BCCC Chair Ian Govey said the code obligations are a crucial safeguard to ensure guarantors understand the risks involved when providing a guarantee. When things go wrong, the committee expects banks to hold themselves accountable, making sure breaches are dealt with appropriately and proactively, Mr. Govey said. Banks should not wait for a guarantor to make a complaint or to raise an issue. The report was noted that when it received claims from guarantors, the Australian Financial Complaints Authority, AFCA, may decide that the bank cannot rely on the guarantee if it finds the company did not meet its obligations in the first place. One case study in the report examined an instance where a bank sought to repossess the guarantor's home after the borrower defaulted on her small business loan. The guarantor, a pensioner whose only income was a disability pension and who had poor eyesight and trouble speaking, had signed the guarantee to assist her daughter, the borrower. The bank pre-filled an acknowledgement saying that she had been properly advised and understood the guarantee before the guarantor had an opportunity to seek legal independent advice and financial advice. The BCCC reported that when the business failed and the bank took steps to enforce the guarantee, its validity was challenged as the bank had difficulty demonstrating how a staff member was satisfied the guarantor knew and understood the risks involved before accepting the agreement. The BCCC also listed 23 recommendations to improve industry practice across staff training, record keeping and data storage, process systems and technology, interactions with guarantors, and checks and balances. Such suggestions include meeting with prospective guarantors face-to-face where possible, requiring staff to consider the guarantor's circumstances when delivering key disclosures, particularly if they need help understanding and collecting guarantor outcome data to track guaranteed trends. And the banks have been urged to consider the report and recommendations against their own practices and to develop an implementation plan to close any gaps. The BCCC expects all banks to take an active role in improving industry practice across the guarantee provisions. Mr. Govey said the committee will follow up with code subscribers to seek updates on steps being taken to implement its recommendations and enhance their capability to comply with the code's guarantee provisions. And the BCCC has said it will follow up with the banks on whether they have improved guarantor and customer outcomes in March next year. Currently, 19 banks have signed up to the Banking Code of Practice, including the Big Four, AMP, Suncorp, HSBC, ING, Citigroup, Bendigo and Adelaide Bank. And the code was developed by and is owned by the Australian Banking Association. So 2 points here. One is self-regulation is pretty ineffective, as you can see. But secondly, many people who become guarantor are not given the right advice, are not making the decision fully informed, and in some cases banks will not be able to rely on that security. So this is a big issue. No surprise then why many are walking away from becoming a guarantor and offering, for example, direct finance via the bank of mum and dad to help people with their finance needs. There was an interesting article published by UBS. They discussed Bitcoin and Ethereum. They said perhaps the biggest debate in crypto concerns if and whether Ether might wrest Bitcoin's crown. Bitcoin has a market cap that is more than twice as big and still boasts around 2/3 more active addresses, but Ether is starting to nose ahead on metrics like traded volumes and trade intensity, to say nothing of transaction counts and overall fees, where it totally dominates. This matters because the so-called flipping reflects network effects that drives prices, but also significant that those two coins embody competing visions of the intrinsic value of cryptocurrencies. Most digital assets can be located on a spectrum that Bitcoin and Ethereum basically define. Bitcoin's proponents play up its scarcity, security, and fixedness, suggesting that it can be thought of as almost exclusively as a long-term store of wealth, which they are adamant will appreciate. Ethereum celebrates its blockchain versatility as a platform for distributive innovation, claiming it can reorder a swathe of our economic and social interactions. Nevertheless, distinctions are less clear-cut in practice, and neither is predestined to champion its archetype, they say. Bitcoin's code appears objectively superior, but still requires periodic upgrades, such as the pending Taproot soft fork, to provide privacy enhancements and support more complex transactions. Its Lightning Network is a Layer 2 solution that is still struggling to facilitate smaller transactions. And it also faces direct competition from some of its own best past spin-offs, such as Bitcoin Cash and BSV, which scale easily by grouping transactions onto bigger blocks. And small quantities already trade on wrapped in ERC20 format on Ethereum's blockchain. ETH exhibits its own contradictions. It started as a non-commercial crowd-funded project, which has since made its own iconic leaguer, Vitlem Buterin, in contrast to the Acrophor Satoshi Nakamoto, into one of the world's youngest crypto billionaires, and now undergirds all manner of commercial ventures. Yet Buterin's all-encompassing vision is often criticised for encumbering progress and creating space for more nimble challenges like Cardio, EOS, Polkadot, Stellar, Tezos, and Solana. Its extensive upgrade schedule often seems as congested as its network, which periodically renders some applications and more complex transactions uneconomic. Polygon's sidechains were launched in April, Arbitrum in May, and the London hard fork, which promised more predictable fees and reduced supply, has just gone live. The transition to ETH 2.0 and proof of stake is now slated for early 2022, which still leaves sharding outstanding as the ultimate way to address scaling. Curiously, some informed observers believe that this is when the Ethereum network will reach its peak. So much for practical distinctions. Are there any unique characteristics in their price action? Well, Bitcoin displays markedly lower volatility, which may be a product of its relative maturity and more diverse investor base, including value players who accumulate on dips and sell spikes. And that's encouraged some to treat it as a funder within the crypto space. But one needs to be careful, as its correlations to stocks have risen structurally and tend to surge during bull runs. Ether exhibits even stronger equity and tech correlations on longer-term horizons, which seems intuitive also, even though its sensitivity to the dollar, gold, US treasuries, and inflation proxies do not screen as materially different to Bitcoin's. And they really make very little sense of where this may all lead. So it's worth watching the continued evolution. And by the way, next week on my live stream, I will have a crypto expert on, and we're going to be discussing who you can trust in crypto land. So keep an eye out for that. Now, over in New Zealand, ANZ has front-run Wednesday's expected official cash rate hike from the Reserve Bank of New Zealand, which some analysts think could be as much as 50 basis points or 0.5%, with home loan mortgage rate increases already announced effective on Tuesday. ANZ has raised its one-year fixed rate special by 14 basis points to 2.69%, its 18-month fixed rate by 15 basis points to 2.89%, and its 2- and 3-year fixed rate specials by 10 basis points each to 3.05% and 3.25% respectively. ANZ last tweaked rates generally higher just 13 days ago. ANZ fixed-rate mortgage specials are available to customers with a minimum of 20% equity and an ANZ transaction account with salary directly credited. Otherwise, standard interest rates apply, which are around 60 basis points higher. ANZ may be front-running the Reserve Bank of New Zealand, just as ASB did prior to the last cash rate review, but in reality they are responding to wholesale rate rises. Wholesale swap rate rises have been strong. In the past 60 days, the one-year swap rate has risen by 75 basis points, up 50 basis points in the last month. And the Reserve Bank of New Zealand probably won't mind the hike by New Zealand's largest mortgage lender, because it will see the market doing the work for it. And if those rates spread, it may be tempted to hold back some of its policy rate hiking. It's not that obvious, but it may temper the impulse to go with a 50 basis point rise and just go 25 instead. The increases that ANZ is pushing through do not absorb, though, all of those wholesale rises, so perhaps there is more to come. And ANZ, by the way, also raised term deposit rates, with their 6-month rate rising just 10 basis points and the one-year term deposit rate up 20 basis points. So it'll be very interesting to see tomorrow what the Reserve Bank in New Zealand does, and whether in fact this does signal the start of rate increases. Of course, over in New Zealand, the COVID story is very different from in Australia, and I still think the Reserve Bank here in Australia will not be moving rates up anytime soon, particularly now. They're probably going to ease rather than tighten. But in New Zealand, I do expect tightening. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.